Hello, everyone. This part, we are going to talk about the form valuation through Fcff model. We'll start from the introduction of Fcff. Then I'll talk about the steps of this model and identifying the relevant items. Then especially talk about the discount rate that we're using here, which is the WACC. Finally, I will explain how we conduct the two-way sensitivity analysis. The FCFF means the free cash flow to firm. It is the cash available to pay investors after a firm pays its cost of doing business, that is operation. So it include both bondholders and stockholders. Regarding the steps of this model, we start from the calculating the forecasting free cash flow to firms. There's two ways to do this calculation. One is start from the net income. One is start from the operating income. For net income, we need to plus back the interest times one plus the interest times 1 minus tax rate. While we start from the operating income, we just start from the operating income, which is the revenue minus COGS minus operating expense. Then we minus taxes, plus back the depreciation and the amortization, then minus capital expenditure and changes in non-cash working capital, the items that will change the cash flow levels. But we can look at the example here. For the forecasting of the next 5 years, free cash flow to firm, we start from the, this approach start from the revenue, then we minus COGS, minus operating expense to get the operating income. Then we less taxes, add back the depreciation and the amortization part. This part are the items that will will impact the cash flow levels regarding we start from the operating profit. So we less the capital expenditure, we less the change in non-cash working capital to get the free cash flow to firm. For the next 5 years, we get the projections of the FCFF. The next step is to get the terminal value. Terminal value is based on the assumption that the company has the infinite life and ever-growing cash flows, which means the firm will grow at a constant growth rate forever. The G represents the terminal growth rate to get the terminal value. So that's a terminal value. We can look at the example. See the terminal value is calculated based on the last forecasting year, the 2024. Then use the formula that I gave you in the point to get the terminal value, assuming the company has a ever-growing terminal growth rate. I want to point out here that the terminal growth rate is very critical regarding the final value of the firm. So that's why we're going to do the sensitivity analysis based on the terminal growth rate at the end. So the next step is to discount based on the time period. as we all know, every time we do the valuation, we can't do it as exactly like 1 year before the next fiscal year and endings. So we need to calculate the time period. As an example, we give you the easier way to make the time period calculated. It's based on the difference between the valuation date and the fiscal year ending date. And just simply divided by 365, you got the time period. And for next year, you can use a similar way to calculate difference divided by 365, or you can just simply add 1 to get the next year's time period. So based on this time period, we can get a present value of free cash flow. I assume you all know how to use the PV function in the Excel. So this is a PV value of the free cash flow for the next 5 years of projection. We also can get the present value of the terminal value using the same methods. So based on these two present value, we can get the form value. It is the present value of the next 5 years of 10 years free cash flow to form plus the terminal present value of terminal value. After we get the firm value through the Fcff model, through the Fcff calculation, we can get the expected the firm value. It is the equity value. The equity value is firm value minus debt plus cash. The way we minus debt is because the equity value is about shareholders but not bondholders. So we need to deduct the debt amount. Then after that, we just divide the equity value by the numbers of shares outstanding to get the target price. You can refer to the example here. After we get the firm value, we add cash minus debt to get the equity value, and divided by the number of shares outstanding, then we reach the target price. This is the example of free cash flow. You can look at it from the Excel sheet. So during the calculation process, there are some points we need to special pay attention. One is the non-cash working capital. So the working capital is the difference between non-cash current asset and non-debt current liabilities. Regarding it is for the operation and it is for the free cash flow to form, we don't include the changes in cash and notes payable and the current portion of long-term debt. These are the items that we should pay attention to. The reason we deduct cash is because cash, especially in large amount, is invested by firms in like treasury bills, short-term government securities. The return on these items is lower than the firm may take on its real investments. Although they have a very low risk. But unlike the inventory, accounts receivable, and other current assets, cash earns a fair return and therefore shouldn't be included in measures of working capital. There are rare occasions that we include the cash, like when when a firm has to maintain a large cash balance for a day-to-day operations, or a firm operates in a market in a poorly developed banking system, we can consider the cash that is needed for operation as a part of working capital. But in general, cash is not considered as working capital. The other part about the notes payable, the current portion of long-term debt, is because they are considered as the financial activities, is interest-bearing debt. So they are not operating items. Therefore, we don't include that in working capital investment. The second one is the depreciation and amortization. Depreciation should be consistent with forecast capital expenditure, which means we think about the company's depreciation. It is always happens after we get the PP&E or the fixed assets. So it should be consistent with what we forecast the capital expenditure. We couldn't depreciate something before we spend that amount of money to build it or buy or get it. So another thing about the amortization is amortization is the term it used for the depreciation of intangible assets. Usually from the financial statement we see them they are stayed together, but actually amortization is about the intangible assets. So it typically happens when the company is doing acquisition of another company. For the capital expenditure is like R&D expenses once they have been recategorized as capital expenditures. Another one, capital expenditure, is acquisitions. So these are the two items we usually look for when we calculate the capital expenditure usually in the cash flow statement. I mentioned before, the growth rate is very critical to get appropriate firm value. So it has to be reasonable. Usually it is relative to the nominal growth rate in the economy. At the same time, the relationship between capital expenditure and depreciation should be consistent with the assumption of the growth rate. I also want to talk about the debt when we calculate the form from the firm value to the equity value. The debt includes all the interest-bearing liabilities and all the leases, because the lease actually include the interest factors already. But that shouldn't include accounts payable or supplier credit. These are operational parts. Another similar debt or liability is pension. As pension are another type of obligation, firm value needs to be adjusted to account for the part that underfunded part. To adjust, we use the underfunded pension part and take out the tax issues, tax shield. For the discount rate and the WACC, discount rate at this model, we use the WACC as the discount rate. WACC is the weighted average cost of capital. The way we calculate WACC is the cost of equity times equity weight plus the cost of debt times debt weight, then times 1 minus tax rate. You can look at the example to see the WACC calculation here. For the cost of equity, we use the CAPM model to get the cost of equity. And for the cost of debt, you can use the bond spread plus the risk-free rate to get the cost of equity, or you can look at the 10K to see like risk motion, the debt, the interest rate. So this is the cost of equity and the cost of debt. This is an example of how we calculate the these two rates. One point I want to point out to you is the discount rate can change over time. We have another point that's presented by one of our fund member, Hazel, about the discount rate changing over time. But I want to make a brief summary here. We can see like the WACC, inputs of the WACC, the cost of equity, cost of debt, and also the weight could be changed. They could be changed over time. So especially for younger firms, they should change over time. So at minimum, they should change to when we get the terminal value, when we calculate, estimate the terminal value, we should assume they have already reflect a mature firm's WACC. But as currently as we conduct valuation mostly for SP 500 firms that we assume mature, so in general we use constant WACC value. Finally, I want to talk about the two-way sensitivity analysis. The reason we do two-way sensitivity analysis because both the growth rate and the WACC has very high influence, high impact on the value of the target price. From this example, we can see if the growth rate change from 2.4 to 1.8, the price could change $10. If it just decrease 0.6%, the price could change $10. Similarly, if it increase 0.6%, the price increase $10. Similarly, for the WACC, you can see if the WACC change a little bit from 7.7% to 8.15%, the price could change from the 120 to 117. Or this one is not so sensitive. So that's why we conduct this to see if it is really sensitive. The way we conduct this sensitivity analysis is using the Excel's table function. I'll show you how to do it exactly, step by step. So here you put the table here. You manually input the growth rate number to 2.4 and manually input these numbers that, or you can add or minus using the calculation function. Here you manually input the WAC number, like here. Yeah, after that I'll clear all of these numbers and put this here at the intersection equals to the value we want to get, which is the target price here. Then we'll do the table function. Go to the data. What if analysis data table? So row input is here. Growth rate is here. C27 column. The column is WAC. WAC is here. C59. Then click OK. Now we get all the numbers here, and we can see the 2.4 growth rate regarding the 7.7 WAC. We get the 120.5 target price is the same here. So that's how we conduct the sensitivity analysis. That's the number.